If you're holding cash right now, looking at the stock market, and waiting for the central bank to cut interest rates before you finally invest, you are playing a very dangerous game. Let's rewind for a second. Think back to the beginning of the year. Wall Street was obsessed with one single narrative. We were promised a massive pivot. Analysts on television were confidently predicting 3 or maybe even 4 interest rate cuts in 2026. Retail investors believed that the era of free money was coming right back, and that inflation was dead and buried. But then the war began and slowly reality hit. The data came in and the narrative completely collapsed. In this video, I am going to break down exactly why the Federal Reserve has its hands completely tied, why the war between Iran and USA changed everything, and most importantly, why this bad news is actually setting up a massive asymmetric opportunity for investors who know exactly where to look. First, welcome back to Rebuild Finance. This channel is about documenting my personal investing journey to a $1 million portfolio. My goal is to find elite companies, ignore the daily noise, and build long-term wealth. If you want to learn how to invest without letting emotions control your decisions, make sure to subscribe. Let's ignore the headlines and look at the real macroeconomic data. To understand why the Federal Reserve is trapped, we have to look at the global domino effect that is playing out in real time. Economics is deeply connected to geopolitics, and right now, the geopolitical map is incredibly unstable. It all starts with the escalating tensions and conflicts in the Middle East. When global stability is threatened, supply chains get disrupted. Shipping routes become dangerous and expensive. And most importantly, the price of crude oil immediately spikes. Oil is the absolute lifeblood of the global economy. You cannot run a modern society without it. When energy costs go up, every single part of the supply chain becomes more expensive. It becomes more expensive to manufacture physical goods in factories. It becomes more expensive to fly cargo across the ocean, and it becomes more expensive for trucks to deliver food to your local grocery store. Companies do not just absorb these higher costs. They protect their profit margins by passing those costs directly down to you, the consumer. And we saw the exact mathematical result of this domino effect in the recent March CPI report. The Consumer Price Index, or CPI, is the main metric the government uses to measure inflation. Going into the March report, nobody was truly expecting a miracle. With the escalating war in the Middle East and the massive spike in crude oil prices over the last few months, every rational investor knew that inflation was going to rebound. The writing was already on the wall, and the official data completely confirmed those fears. The March CPI report came in hot, proving that the cost of living is becoming incredibly sticky again. We are not just talking about the obvious temporary spikes at the gas pump. We are seeing sustained inflation in the core expenses of human life: housing, food, transportation, and auto insurance. The easy part of the inflation fight, bringing it down from its massive peak 2 years ago, is completely over. Getting it from 3.5% back down to the Federal Reserve's strict 2% target is going to be a brutal, agonizing process. The last mile is always the hardest. Just a few months ago, the market was expecting interest rate cuts. That was the bullish story everyone wanted to believe. But the war changed the picture. Higher oil prices, more inflation pressure, and a hotter economic backdrop now make those cuts much harder to justify. And that is the real problem. The Federal Reserve does not necessarily need to raise rates again, but it no longer has the freedom to cut them as easily as investors expected before the conflict escalated. In other words, the Fed's hands are tied, and the market now has to adjust to that reality. So, what does a trapped central bank mean for your portfolio? Does a lack of rate cuts mean the stock market is doomed to crash? Absolutely not. In fact, it creates one of the best setups for rational investors. Here's the fundamental secret that institutional investors understand, but retail investors usually miss. The financial markets are forward-looking. The stock market does not care about what happened yesterday. It only cares about what will happen 6 months from now. And the stock market has already digested all of this bad news. The reality that we are not getting immediate rate cuts is already priced in to current stock valuations. The big Wall Street funds have already adjusted their models. They already know inflation is sticky. They already know the Fed is trapped. When bad news is already expected by the masses, it loses its power to crash the market. Think about the asymmetric risk we are facing today. It is a concept where the potential upside heavily outweighs the potential downside. If the Federal Reserve simply does nothing for the next 6 months and keeps rates exactly where they are, the market expects it. It is not a shock. The market might trade sideways or experience slight volatility, but a massive crash is unlikely because there is no surprise. But what if we get an unexpected surprise? What if geopolitical tensions in the Middle East suddenly cool down? What if oil prices drop back to $70 a barrel? What if the Fed actually finds a narrow window to execute just 1 or 2 rate cuts later this year? Because the market has completely priced out the possibility of rate cuts. Any unexpected positive news, even a small one, would send the S&P 500 absolutely skyrocketing. The relief rally would be massive. This brings me to the biggest mistake you can make right now, the cash trap. I hear so many retail investors saying the exact same thing. They say, I am earning 4 or 5% in my high yield savings account. I am just going to hold cash, wait for the Federal Reserve to cut rates, wait for the Middle East to calm down, and then I will buy stocks when it is safe. That sounds logical, but it is a mathematical disaster. First of all, your 4% yield is fully taxable, and after factoring in current inflation, your real return is practically zero. You're just treading water. Second, there is no such thing as a safe entry point. The stock market does not ring a bell at the bottom to let you know it is time to buy. By the time the macroeconomic picture is perfect, by the time the news is entirely positive and the Fed officially announces that inflation is defeated, the stock market will already be up 20%. You will have missed the entire rally, and you will be forced to buy back in at much higher prices. My strategy for dealing with a trapped Federal Reserve remains incredibly boring, completely emotionless, and mathematically bulletproof. I am ignoring the day-to-day noise. Even though the central bank has its hands tied, elite businesses will continue to operate. Great companies will continue to innovate, generate massive free cash flow, adapt to inflation by raising their prices, and grow their earnings over time. Instead of trying to time the absolute bottom, I am continuing to aggressively apply dollar cost averaging. Every single month, regardless of what the inflation report says, I am buying high quality individual stocks and broad market ETFs at fair valuations. If the market drops next week because of an inflation scare, my monthly investment simply buys more shares at a heavy discount. I lower my average cost basis. If the market rockets higher because of an unexpected rate cut or a drop in oil prices, my existing portfolio immediately grows in value. You do not need a perfect economy, a peaceful world, or a predictable Federal Reserve to build long-term wealth in the stock market. You just need high-quality assets, extreme discipline, and the patience to stay invested when everyone else is holding cash out of fear. Now, I want to hear from you. Do you think inflation is going to stay sticky and prevent the Federal Reserve from cutting rates this year? Or do you think the market will still get the rate cuts it has been hoping for? Let me know down in the comments below. I read and respond to all the comments. If you found this video helpful, please hit the like button. It really helps the algorithm push this video to more investors who need to hear this message. And if you want to follow my journey as I build a portfolio to $1 million, make sure to subscribe. Thanks for watching, and I will see you in the next one.